Now, you might be wondering, why is this fellow talking about debt? Isn't that something you try to avoid? Well, in the world of business, it's a bit more nuanced than that. You see, debt, much like a sharp tool, can be incredibly useful when handled with care and precision. Just as a skilled craftsman uses a chisel to shape a masterpiece, a savvy entrepreneur can use debt to sculpt a thriving business. We'll examine various types of debt instruments, weighing their advantages and understanding the risks involved. My aim is to equip you with the knowledge and insights to make informed decisions about debt financing. So, let's roll up our sleeves and get down to business. Leverage, in its simplest form, involves using borrowed capital to magnify your potential returns. Think of it like this. You're using someone else's money to potentially make yourself more money. The fundamental idea is to ensure that the return on the borrowed capital outpaces the cost of borrowing, which is essentially the interest you pay. This difference, my friends, is where the magic happens. Imagine you have a business that consistently generates a 15% return on investment. Now, let's say you secure a loan at a 5% interest rate. By investing those borrowed funds back into your business, you're essentially pocketing the 10% difference. That's the power of leverage. Of course, like any powerful tool, leverage comes with its own set of risks. If the return on your investment falls short of the interest rate, you could end up worse off. The key takeaway here is that leverage is neither inherently good nor bad. It's about understanding the dynamics of your business, carefully assessing the risks and rewards, and making calculated decisions that align with your overall growth strategy. Remember, just as a well-placed lever can move mountains, strategic use of debt can propel your business to new heights. Now, let's talk about the different flavors of debt available to businesses, each with its own purpose and set of terms. Understanding these options is crucial for making informed borrowing decisions. First, we have the old reliables bank loans. These come in two main varieties: fixed and variable interest rates. Fixed rates offer predictability, while variable rates can fluctuate with the market. Bank loans are often used for working capital needs, like managing inventory or payroll, or for funding expansion projects. Next, we have lines of credit, which offer more flexibility. Think of it like a credit card for your business. You can borrow up to a certain limit, repay, and borrow again as needed. This is particularly useful for managing cash flow fluctuations. For larger scale endeavors, businesses might turn to bonds and debentures. These are essentially IOUs issued to investors, promising repayment with interest over a set period. Each of these debt instruments serves a specific purpose and comes with its own set of terms and conditions. The key is to carefully evaluate your business needs, risk tolerance, and financial situation to determine the most suitable type of debt for your unique circumstances. Now that we've explored the different types of debt, let's delve into how businesses strategically leverage them for growth. One of the most common uses of debt is for expanding operations. Need to open a new location or increase production capacity? Debt can provide the necessary capital infusion without requiring you to dilute your ownership by issuing equity. Then there's the world of acquisitions and mergers. Companies often use debt to acquire competitors or complementary businesses, expanding their market share and achieving economies of scale. Debt can also be instrumental in capital investment in technology and innovation. Investing in cutting-edge technology or research and development can give you a competitive edge, and debt financing can make those investments feasible. The key takeaway here is that debt, when used strategically, can be a powerful catalyst for growth. It's about identifying the right opportunities, understanding the associated risks, and deploying capital in a way that aligns with your long-term business objectives. Now, let's talk about the upsides of using debt strategically. One of the most compelling benefits is the potential for leverage to increase returns. As we discussed earlier, if the return on your investment exceeds the cost of borrowing, your profits get a healthy boost. Another advantage is the tax advantages associated with debt financing. Interest payments on debt are often tax deductible, which can reduce your overall tax burden. Unlike equity financing, where you give up a portion of your ownership, debt allows you to maintain control of your business. Debt can also act as an inflation hedge. If you have a fixed-rate loan, your payments remain the same even if inflation rises. Understanding these potential advantages can help you make more informed decisions about using debt strategically. Now, let's address the elephant in the room: the risks associated with debt. Just as a sharp tool demands respect, Leveraging debt requires careful consideration of the potential downsides. One of the most significant risks is over-leveraging. Taking on too much debt can strain your cash flow and put your business in a precarious position. If you're not careful, it can even lead to default or bankruptcy. Another risk is interest rate fluctuations. If you have variable rate loans, rising interest rates can eat into your profits and make it more challenging to meet your debt obligations. Economic downturns can also pose a significant challenge. During recessions, businesses often experience a decline in revenue, making it more difficult to keep up with debt payments. By carefully assessing the risks and implementing sound financial management practices, you can mitigate these potential downsides and use debt responsibly. Navigating the world of debt requires keeping a close eye on your financial compass. Several key metrics can help you gauge your debt levels and assess your ability to manage it effectively. First, we have the debt-to-equity ratio, which measures the proportion of debt to shareholder equity. A lower ratio generally indicates a more stable financial position, while a higher ratio suggests a more aggressive use of leverage. Next is the interest coverage ratio, which assesses your ability to cover interest payments with your earnings. A higher ratio indicates better debt management, as it means you have a larger cushion to meet your interest obligations. Return on assets, or ROA, is another crucial metric, showing how effectively your assets, including those financed by debt, are generating profits. A higher ROA indicates that your business is using its assets efficiently. By monitoring these metrics regularly and understanding their implications, you can gain valuable insights into your debt position and make informed decisions about borrowing, repayment, and overall financial strategy. Chapter 7. Best practices for leveraging debt. Now, let's distill some best practices for using debt effectively and responsibly. Remember, it's about using debt as a tool to enhance your business, not as a crutch to lean on. First and foremost, don't borrow just because you can. Borrow when you have a clear purpose, a solid plan, and a reasonable expectation that the investment will generate sufficient returns to cover the cost of borrowing. A mix of both can provide flexibility and reduce risk. Relying too heavily on one or the other can create vulnerabilities. Whenever possible, favorable interest rate environments don't last forever. When you find a good deal, seize it. Ensure timely repayments to avoid penalties or, worse yet, defaults. Chapter 8. Real-world examples of leveraging debt. To illustrate the power of strategic debt utilization, let's look at some real-world examples of companies that have used it effectively. The e-commerce giant has strategically used debt to fuel its expansion. They've invested heavily in their logistics network and made strategic acquisitions, like Whole Foods, using debt financing to support their growth. The electric vehicle manufacturer is another prime example. They've used debt to build their gigafactories and ramp up production, betting on future revenue from electric vehicle sales to offset early debt burdens. These examples highlight how companies across different industries and stages of growth have successfully leveraged debt to achieve their strategic objectives. Chapter 9. Conclusion. As we've explored throughout this discussion, the strategic use of debt can be a powerful catalyst for business growth, amplifying profits and unlocking opportunities that might otherwise seem out of reach. However, it's not a magic bullet, and it requires discipline, foresight, and sound financial management. The art of leveraging debt for profit lies in striking a delicate balance, seizing opportunities without overextending, managing risk effectively, and continuously monitoring your financial health. Remember, debt is simply an instrument, much like any other financial tool at your disposal. When used strategically, debt can transform a good business into a thriving one. By making informed decisions and managing your finances responsibly, you can harness the power of leverage to propel your business to new heights of success. Outro: Mastering the art of leveraging debt for business growth. In closing, remember that the journey of entrepreneurship is rarely linear. It's filled with twists, turns, and the occasional bump in the road. Debt, when used wisely, can be a valuable tool on this journey. So, go forth, embrace the art of leveraging debt responsibly, and watch your business flourish. Like, comment, subscribe.